So the consensus in the market today is that numerical research is good, but you can't ignore behavioral finance. So this also takes us to sometime in 1970s when Lawrence Fisher and James Lowry presented a paper on diversification and said all the benefits of diversification, or 95% of the benefits of diversification comes from 30 stocks. And they did this in the US context. We don't know how far it is true in other places, but that is the figure of 30 which you get, which is what today all focus funds do. Though of course some focus funds managers say 30 is too much, so I have only 25. But the norm is 30 in focus stocks, and other portfolios also start with 30. They go to 40 or 50, and some go even as high as 120, 130, depending on whether it's a small cap, and then they start pruning, and then they will come down to a size much lesser, but nowhere near 30. You cannot do a 30 share focus small cap fund. I have not seen something like that. So small cap funds will have large number of stocks, but largely this 30 comes from this research of the 1970s, where he said 95% of the value is already captured there. So of course now many people would have 40 or 50, but the starting point for most of them has been 30. In 2017, Hendrik Bessembinder did a research saying, is it worth being in stocks at all? Very interesting, because he compared the performance of stocks to treasuries, and he found that only 4% of the shares or stocks had beaten the treasury. I mean, all the other shares were giving same return as the treasury. So he felt the need to take risk is not there. Why would you take a risk to get treasury kind of return? Which brought us to the fact that the risk of a fund manager not picking that from that 4%, right? So suppose there is a fund manager who did not pick up anything from that 4%, very difficult maybe, but assuming he did, which means he has underperformed the treasury, and definitely underperformed the treasury after expenses. So it became, why should I take so much of risk? So let me go and buy the index. So 2017, when this research came, it created quite a furor, and after that, from 2017 to 2024, we have seen a lot of shift from active managers to passives to ETFs, etc. So that is also a new trend. But yes, what I'm trying to drive at is from the 1950s to 2017. If you take all the research, you realize that there is a lot of theories in equity investing. Somebody said the market is perfect. Then somebody said, look, the market is never always perfect. There are opportunities in which to make money because of these imperfections in the market. It takes a long time for the market to correct, right? So somebody finds out that Narendra Modi is coming back, or Narendra Modi is not coming back. I mean, this happened in the case of Trump. Many people said Trump is coming and therefore we should short the market. They were right, they had to short the market, but within 2-3 months the market said, so what if it is Trump, he's far right and he'll do this, and the market actually went up. So your ability to predict the market was right, but to say what will happen was right, but you didn't know that the market will react so fast. So again, there is behavioral finance at work, of people saying, no, it doesn't matter, it's worthwhile if it is Trump, right? So when Narendra Modi came in 2014, we had no clue what he's going to do for the market, though we had some indication of what he had done in Gujarat. But today in 2024, if he doesn't come back, we have no clue how to handle the situation, right? So then again, behavioral finance, so market might go down and then market might recover, saying, oh, it doesn't really matter, this new person is also good, whoever it is, I'm not even guessing, right? So one thing very clear is equity research really requires a lot of money, time, patience. So all the equity research that you see in the world is US driven. Very little research is done in India. So we have to believe what the Americans say about what equity will do. And we also realize that different strategies have worked at different times for different people. Sir John Templeton believed that he had to go out of the country. So he went out of US, he identified Japan, he identified many growing markets. many emerging markets, and he invested and he made a lot of money. Warren Buffett, on the other hand, did not go abroad at all. He had a home bias, and all his companies were America based, US based mostly. But he also had companies like IBM and Coke, which went outside and did business, right? So some kind of a diversification Buffett also got, but clearly going to foreign markets is something which John Templeton did. Completely different strategies, but with very good results. So you realize that in investing, it's necessary that you know the history. You go and learn the history of what people did, why they did, etc., and then see how you will behave under those circumstances, and based on that you start investing. Right. So whether indexing suits you or whether active investment suits you, in your active investment you may have got just one thing right, but that itself may have meant the whole total portfolio returns have beaten the index. So what? It doesn't matter, right? You don't have to prove to anyone that the standard deviation was high or low, the Trainer ratio and Sharpe ratio you calculated. You don't have to answer those things. You said, okay, I think this is a good company, I'll stick to it. You didn't mind it becoming a bigger part of your portfolio, and that made money for you. So that's more important. It's far more important that you make money in the market than worry about how it is made, right? How it is made in the sense theory. What does theory say? For example, a risk is something which Markowitz, Markowitz defined this efficient portfolio, and he said to be on the efficient portfolio, this is the amount of risk. To get higher returns, you have to take more risk, and if you don't take more risk, you will not get higher returns. This is Markowitz's way of saying, but I think but there are people who, at least I don't see standard deviation, beta, Trainer ratio and Sharpe ratio as great indicators of risk, because if I can sit tight during drawdowns, then I don't see variability as a big risk. In fact, I think Seth Klarman said that it is preposterous to use, let me use his exact language. Markowitz used risk, I mean in his theory he used risk as variability, and I think it is, Seth Klarman said, he argued that the use of volatility to measure risk is preposterous. I mean, he's come out much stronger than me. And his firm, Baupost Group, specializes in securities that are distressed. So when you are buying distressed assets, when a share price drops from 6 to 3, he is more convinced that it is worth buying because he is a value investor. Does value investment work? Yes, value investment works. Does momentum investing work? Yes, momentum investing works. You have to decide what is good for you. So then beating the market, Pharma said you cannot beat the market because market is already efficient. But there are enough people like, say, Peter Lynch, Naren, Prashant Jain, all these people who have beaten the market and beaten the market by a mile. So how did these guys do? Why was the market not perfect in US, or was the market not perfect in India? Again, difficult to judge. So don't get too much into all these theories. There are a lot of theories. You should know that these theories exist. If you go around I mean, I've done one video saying the benefits of technology. All this what I've got is from the net, right? I have not picked up these books and read, at least not for doing this video. Markowitz is something which I have read, but I have never used, right? So that's more important. Seth Klarman is far more useful to read, perhaps. So then you have to stick to value investing. And some portion of my money is in momentum investing, which my broker handles. I don't even ask him what he buys and what he sells. So that works for me. Some portion of my portfolio is like this, and some portion of my portfolio is like that. So theories exist. You have to see what works for you and what makes money for you. Thank you.